Welcome to Bloomberg ETF IQ. I'm Scarlett Fu.
And I'm Katie Greifeld. And we have a new set, actually. There's a desk over there.
Yeah, there's a big desk, new set, but we're still here. They haven't kicked us out yet.
Not yet. So let's get to the biggest stories right now in the more than $12 trillion global ETF industry. Wall Street analysts warn of a possible shock to markets as we get a double dose of eco headlines with U.S. CPI and the Fed decision both on Wednesday this week.
Plus, the biggest ETF tracking CLOs reaches $10 billion in assets, showing Janus Henderson's dominance in this space. We're going to speak to its head of Securitized products, John Kerschner. And as this weekend's European Parliament results unnerve investors, we look at the region's fund flows as they neared a record ahead of the vote. But first, Eric is actually on assignment. We'll be catching up with him later on. So, Katie, you are taking a look at the flows here in the U.S.
I'm going to do my best Eric impression. So let's take a look at where money was actually flowing in the week that was. And this is kind of a weird week. I'll put that up front. You can see that VU took in money, close to $12 billion. That, of course, is your S&P 500 tracking fund. This is a growth fund, actually, IVW, taking in $3 billion as well. Small caps also seeing a bit of love. But then you switch up the board, and again, it's kind of a cross current here because then you had the likes of IVV, SPY, for example. They both track the S&P 500. They actually lost money, and they lost quite a bit of money, close to $19 billion there. The one clear message, though, is that you had value losing some money. That is EFW. That is a value fund losing almost $1 billion or so. So money going into growth, coming out of value, and coming out of stocks as well. You can see the chip makers lost a bit of money. But let's talk about active, because no matter the market environment, it seems that active ETFs just continue to take in cash. And you can see that in this chart behind me. We are looking at 50 straight months of inflows, which is just amazing, into active ETFs, according to Bloomberg Intelligence. And you can see that these blue bars have really been growing. So not only are we seeing these consistent flows into active, but they're getting bigger as well. So rain or shine, Scarlett, active ETFs just continue to take in cash.
Yeah, they're kind of like the all-weather funds right now. Katie, thanks so much. Joining us now for our conversation is Amrita Nandakumar. She is president of Vident Asset Management. Amrita, so good for you to be here with us. Thank you so much.
Thanks for having me back.
So what do you think are the macro or cyclical conditions right now that are favoring or perhaps benefiting active ETFs over, say, passive ETFs?
With active ETFs, they're designed for specific goals, right? And in this case, we're talking about navigating through market uncertainty, right? As Katie just talked about, big week coming up with, the Fed decision and the CPI numbers. So it's not surprising that if you're an investor or a financial advisor, that you might be looking to active managers and active ETFs to help you navigate that uncertainty and help you figure out where you still want to be exposed despite the volatility or the further uncertainty to come.
And I think it's interesting how the active bid has evolved, because for a while it seemed like it was the income-based products, the Jeppies of the world, and its various copycats that were taking in all the money. But then you take a look at the new trends in active ETF issuance, and they've been getting more and more concentrated. You've seen a lot of funds launch with fewer than 50 holdings, and I'm curious what trends you're seeing when it comes to both what issuers are looking to launch and also what investors actually want to put their money behind.
I think that's a great point, and certainly what we're seeing at Vident. At Vident, we partner with active managers that want to bring their strategies to market in an ETF wrapper. And I've definitely observed over the last 12 or 18 months or so that active managers are coming to us with very concentrated portfolios, 30, 35, maybe 40 names at the max. They're very, very particular about their strategy and what they're trying to hold. And so I want to believe that investors, and particularly as financial advisors that have confidence in these asset managers and these active managers in particular, that they would be comfortable with that type of concentrated exposure.
And I mean, the pushback that you always get is that, okay, maybe when you concentrate your portfolio, you see a pop when times are good, but when times are bad, they're really, really bad, and you lag the benchmark. I mean, you've been in the ETF industry for many, many years. How do those boom and bust cycles typically look when it comes to concentration?
That's a great question, and I think what the beauty of the active ETF wrapper is that it makes it so easy to exit if, as an investor, you're worried that things are going south, right? You can exit, you'll know when you exit, you can exit the time of day that's convenient for you or that seems right to you, and so you can build a portfolio with ETFs that really match the exposure you're trying to get or have the managers that you want exposure to, knowing that as long as there's enough liquidity, you should be able to get out without too much of a hit.
You mentioned managers that you can get exposure to. What does active really really mean? How similar is it to a mutual fund where you have a lead portfolio manager and a team of analysts supporting that PM? How does it compare to, say, an active quant fund, which seems like a different animal completely?
That's a great point. So you're right, with traditional active management, we're talking about the quote unquote your stock pickers, right? Your lead PM, your analyst supporting that person. And then of course on the systematic side, it's similar in that it is really, it's following a similar strategy, but at the end of the day, they're not as concerned about what ends up in the portfolio. They just want to know that their system is working. On the other hand, we're actually also seeing the emergence of more closet indexers. So active managers that are starting with an index as their universe and then making changes as they want. And in some cases, those might be rather minimal changes. So think back to last year where you might have wanted to kick out that regional bank name, or the year before when you might want to kick out that Russian equity name. And so what we're finding is that there's different flavors of active. And so active as a term has become a catch-all for very different types of strategies, leading investors to wonder, how active is my active ETF? And I'm wondering that if as an industry, should we be thinking about maybe a more specific nomenclature to help investors navigate through the activeness of their ETF or lack thereof?
I think that's a really good point, too. And you also think about single stock ETFs. Those are all considered active as well. And I guess if you're buying one of those, that is an active decision, but not active in terms of picking out a traditional portfolio. But I also want to get your thoughts on distribution. This is something that I talk about all the time with you, but it just feels like it's just getting harder and harder. I mean, Emily Graffeo and I have been reporting on Fidelity, for example, in conversations with issuers about potentially charging when it comes to their platform. And from your perspective, of course, where you sit when it comes to helping ETF issuers bring their strategies to the market, how much more difficult has distribution come? And if costs are going up, where can an issuer then cut costs?
Yes, you're right. The distribution challenge only continues to grow, and Fidelity's decision to start charging certain issuers a percentage of their management fee or their revenue, that's a significant one. Now, of course, some people will point to mutual funds and say, well, they've been doing it for so long, but we're talking about higher expense load, trailers, all the things that we were trying to get away from with the ETF wrappers. So you're right. It's just the challenge just keeps continuing. And so at Vident, what we tell our aspiring issuers is make sure you are keeping your eyes open, you are well aware of the challenges ahead, and come with plenty of working capital. What you don't want to be is in a position where you start to take off and then you don't have the money to support your marketing or distribution strategy.
And in terms of how this could evolve, of course, if costs are going up to get on some of the platforms, could we see ETFs become more expensive? Margins are already razor thin as it is.
That's a tough question. It's really between being a rock and a hard place, right? Because one of the trademarks of the ETF is those competitive expense ratios. And so you're right, how much are sponsors, and particularly active managers, going to be able to get away with in terms of increasing that expense ratio to make up for the margin that they might be losing? It's a delicate push and pull. We try our best to support our managers, but ultimately they need to know the market that they're targeting and what that market's willingness to pay is.
I have a final question for you about the daily disclosure of active ETFs, because that was a big concern early on. It would encourage short-termism. It also would perhaps give away someone's secret sauce and inspire copycats. Is that actually happening now that we see active ETFs really out in force? What are some of the unintended benefits of having daily disclosure for active ETFs?
What you described was very much the narrative that I think we were all as an industry focused on. Are active managers going to be okay with daily disclosure? Are they going to be concerned about front running? And on the investor side, do investors really need to be focused on what's in their ETF day to day? But I think what we fail to recognize is that this daily transparency would actually be a benefit to financial advisors. Financial advisors who can have these conversations with their clients and say, here's what you hold, here's how much you hold, here's what you don't hold. And what we're hearing at Vident is that it really has strengthened the relationship with the clients and has allowed the FA the opportunity to better explain the investment decisions that they're making on behalf of the client.
Yeah, and if you just follow the money, it seems like that is where all the appetite is for that daily disclosure. Amrita, it's always great to see you. Really appreciate your time today. Our thanks, of course, to Amrita Nandakumar of Vident Asset Management. Now, coming up, we head to Paris, where top voices discuss the future of blockchain amid Bitcoin ETF approval. Eric Balchunas joins us live from Paris next.
Who's that?
We'll find out. This is ETF IQ on Bloomberg. Welcome back to Bloomberg ETF IQ. I'm Katie Greifeld. It's time now for the ETF Brief, where I walk you through the trends and the stories that caught my eye in the ETF industry. And we start with concentration. We were talking about this a little bit with Amrita, but you take a look recently over the past couple years or so, it's the most concentrated ETFs in orange there that have been outperforming the least concentrated cohort. Of course, the exception to that would be 2022, when you had the entire market go down. That's when the least concentrated ETFs outperformed. But recently, again, on average, it tends to be the most concentrated active equity ETFs that are in charge. So we're going to continue to keep an eye on that one. Let's check in on one of our favorite charts on this show, though, and that, of course, is ETFs versus mutual funds. And I mean, it's just gorgeous. You can see in blue you have the ETF net flows, and they've just been taking in cash for about a decade or so, even more than that. And then it's a zero-sum game, because on the other side, in orange, you have mutual fund flows, and they have just been losing money for years and years. You can see 2024, the losses from the outflows from mutual funds haven't been as bad, but still ETFs in the lead. And let's talk about Europe as well, because it's not something we do too often on this show. And maybe we should, because you look at May last month for European ETFs, they were at a record or pretty close to it. 25 billion euros came into Europe ETFs, Scarlett, and you can see that was quite a pickup from the year before.
All right, so let's talk about this a little bit more right now with our very own Eric Balchunas, who is not in New York. He's actually in Paris this week on assignment. We'll get to that in a moment, Eric, but let's stick with the European theme here, because as Katie just mentioned, Europe ETF inflows have doubled to a near record level, but you've noted that turnover is down by some 15%. Explain what you think is going on here.
Yeah, it's actually not bad. It tells you that more long-term investors are getting in. Turnover, which is trading volume, and ETFs, they tend to be correlated with volatility. Like, in other words, if there's a bad feeling or the market's selling off, people start trading ETFs a lot. So if they're not trading and the flows are going in, it just tells you, hey, look, I'm pretty bullish, I'm pretty calm, I'm putting money in. So a lot of flows, low turnover is about as bullish as it gets. And May was big across the globe. And in Europe in particular, you know, one of the things here is these flows are in spite of some headwinds. For example, there's not a lot of advisors that get paid in terms of fee-based. They still get what they call inducements here. So ETFs have to fight that system. They also have to fight a population in many of these countries that just kind of assumes the government will pay for its retirement, although that's changing. Young people don't feel that way. So those two things, I think, as they develop in Europe, the flows will be even greater.
So great context there that it's really around the globe, but Europe as well, particularly hot in May. Hot in June, apparently, because you're over there in Paris. What's going on?
Yeah, I'm here for a couple of reasons. We have our big event in London, which I'm going to in a couple of days. But in Paris, there's a Bitcoin event, crypto event called Proof of Talk. We've been invited to some of these lately as we've been covering this over the past year. And I did a panel with Olivia Snyder of 21 Shares and Van Eck, and they want to know, like, what's going on with the Bitcoin ETFs. But another thing they want to know about is tokenization. There's this talk, and I've heard it a lot in the past couple of days, that ETFs are going to be replaced by tokens on the blockchain. So whatever you want, S&P, junk bonds, you're just going to have a token for it. I'm still not sold on it. You know, as an ETF guy sitting there, I almost feel like a mutual fund guy at an ETF conference like 20 years ago, maybe. But I'm not that sold that they're going to replace it. There's a lot of questions, and also ETFs are so easy and cheap and convenient for the end consumer. It's hard to see them getting disrupted, but we're keeping our eye on it.
So it sounds like you're the voice of the skeptic out there at that conference, or you have been. You're moving on to London for an event. Can you tell us a little bit more about that and what you hope to glean from it?
Yeah, it's our ETFs in Depth event, which we do in New York. Obviously, this one's in London, and we're coming out with a pretty big prediction. We think that the global ETF market will go and triple in assets to 35 trillion by 2035. We're as bullish as ever for a variety of reasons, especially in the U.S. You've got the share class thing coming down the pike. But, you know, you talk about the flows in May. We just keep seeing a lot of interest. And so we're basically, that's only a 10% annual growth rate, too. That's actually kind of conservative. So we're going to basically kick it off with that. That note's coming out tomorrow or Wednesday. And then we'll basically have a bunch of panels. It should be pretty fun.
Pretty fun. It sounds like you're having a great time over there. And 35 trillion by 2035. I just wrote that down. So we'll check in about 11 years or so. Eric Balchunas, great to see you. Have fun over there. Still ahead, Janus Henderson's AAA CLO ETF hits $10 billion in assets. We'll be speaking to John Kerschner on the issuer's dominance next. This is ETF IQ on Bloomberg.
This is Bloomberg ETF IQ. I'm Scarlett Fu along with Katie Greifeld.
And it's time for today's drill down, where we focus on one ETF. And in the hot seat today, we have JAAA. This, of course, is a AAA rated CLO ETF from Janus Henderson. It controls 90% of CLO AAA rated ETF assets, and it was launched about 4 years ago. So it really speaks to the dominance of this particular product. So again, the ticker here is JAAA. It's an actively managed fund. It charges just 21 basis points, which is very, very inexpensive. It's not exactly the cheapest, but it's pretty close. And it's not exactly the first of its kind, but it's pretty close. And all of that has added up to really help boost its assets. So let's talk about that now, because one of the reasons that we've been keeping an eye on this fund is because it has been getting closer and closer to $10 billion in assets under management. And you can see we finally got there, finally hitting that $10 billion mark. Of course, the first CLO ETF to ever do it. And it's interesting because this year alone, it's actually nearly doubled its assets. It came into 2024 with about $5.3 billion in assets under management. So in just about 6 months' time, it's already hit $10 billion or so. So really impressive growth. Let's talk about the performance as well, because of course flows follow performance, and we've seen that when it comes to this ETF. Of course, CLOs, they're floating rates. So as rates go up, that's good for this ETF. They generate more income, and you can see that in these total return figures. Over the past year, JAAA has returned about 9% or so on a total return basis. You compare that to the ag, of course, and it's returned about 2% or so on a total return basis. So those rising rates have definitely helped, Scarlett, when it comes to the performance and the growth of JAAA.
All right, Katie, that is a great setup. So let's talk a little bit more about this ETF with John Kerschner. He is U.S. Head of Securitized Products and Portfolio Manager at Janus Henderson. John, it's great to see you.
Yeah, thanks, Scarlett. Thanks for having me back.
So Katie was just mentioning how when rates go up, that is good for this ETF, JAAA. Can you tell us a little bit about what the journey's been like the past year, where we were pretty sure that rates were going to be cut, but right now it's looking like higher for longer?
Yeah, it definitely seems like a higher for longer environment. I mean, remember, beginning of the year, the market was pricing in 6 or 7 cuts. Now we're down to 1 or 2 cuts. We think it's probably 1 and maybe even 0. So about a year ago, people are already asking us, when's it time to get out of JAAA? And we said, no, this trade has a long way to go. And here we are sitting in June, and we think it still has another year or 2 to go. The market is telling you that the yield curve is not going to be flat for another 2 years. So I think that's key for people to realize that this isn't like in and out. This is something you can hold for a very long time.
Well, I want to talk about who's buying and who's holding it, because it was interesting. There was a Citi note, I think it was last week, that took a look at the CLO ETF field, and their analysis showed that JAAA was the only one of those ETFs that had an institutional user base, a use case there. So when you take a look at the growth that you've seen, doubling assets over the past 6 months or so, is that institutions? Is that retail? What does the breakdown look like?
Yeah, we really like that piece from Drew Pettit at Citi.
I imagine that you would.
No surprise there, right? And what we also liked about it is they were forecasting the market to grow on a baseline to $35 billion and maybe even up to $55 billion. So that's obviously very good for this asset class. Look, it's a broad range of investors that have been buying JAAA. A lot of retail, also what we would think of as more institutional, but financial advisors, OCIO, outsourced chief investment officer type platforms. Those platforms are actually more institutional as far as experience and ability. But as far as pure institutional pension funds, large banks, we do have some, but it's not the bulk of our investors. It's mostly smaller investors.
What's the specific pitch to those smaller investors, to retail investors? Because CLOs, for some people, might bring back memories of 2008, 2009. And so there's a bit of education in there, I'm sure.
Yeah, you guys are helping bring back those memories because every time I come on, we talk about that. But yeah, I mean, it's very simple. Look, we're solving a problem that most people have when building portfolios. Where can I get high quality floating rate fixed income with a pretty high yield? And that's, before we launched JAAA, that was very hard to find. And people want floating rate because they don't want a lot of interest rate risk. They want high quality because the economy is slowing down. And obviously, they want those high yields. You showed at the beginning of the piece just how good the returns have been. And obviously, they come with a big dose of disclaimer because past performance isn't guaranteed a future. But cash last year, you know, returned right around low 5%. That makes sense. That's where the Fed funds is. But JAAA at 9 and JBBB, our BBB CLO, at 17. That's very attractive to investors.
I want to talk about what the impact on the broader market is, especially when you think about some of those projections for how big the CLO space in ETF land could get. There was an interesting piece from my colleague Scott Carpenter interviewing someone from PineBridge saying that you take a look at the money going into CLOs. That has been a huge catalyst for tighter CLO spreads in the underlying market. Do you think that there is sort of a feedback loop going on there?
Yeah, no question. And it's interesting. We see a lot of street research these days actually taking into consideration the bid from CLO ETFs. It's been a very strong issuance year for CLOs. I think it's second strongest on record. But there's been a lot of liquidations and a lot of amortizations as well in the CLO space. So actually the net issuance has been negative. And a lot of that's also driven by CLO ETFs because of all the demand. Like you said, we've doubled in size almost this year. Others are growing as well. And we think that will continue. And that will consequently tighten spreads in CLOs.
I literally have 30 seconds left with you. But on the other side, if we were to see mass outflows, what would that mean for the market?
Look, you know, we don't see that happening, absolutely. I think it's a very liquid market. We've had outflows before, both in JAAA and JBBB, because the market's so liquid. We had no problem giving investors their money back. This isn't an interval fund. This isn't like the real estate funds out there, so investors shouldn't worry about that.
All right, John, really great to see you. Appreciate your time on this Monday. Our thanks to John Kerschner of Janus Henderson. And if you just can't get enough of ETFs, good news, you can subscribe to my weekly ETF newsletter that covers the industry. But that does it for Bloomberg ETF IQ. I'm Katie Greifeld, along with Scarlett Fu, and this is Bloomberg.